I'm Louise Bedford, the Money Chick, and I'm also the host of the Talking Trading podcast. This is how traders excel. Today, I am interviewing Petra Bakosova. Petra is the CEO of Hull Tactical Asset Allocation. Not only is she a quant, so she's fantastic with numbers, but she also shares a couple of the passion areas in my life at the moment, which is trading ETFs and AI, artificial intelligence. We are told that it is going to change the entire format of what we do as traders, but is that the case? Petra is the expert, and she's going to answer some of my specific questions about AI, and you are going to get a glimpse into the future of trading. How it is today is not how it's going to look tomorrow. So let's get rolling. Petra, welcome to the show.
Hi, Louise. Thanks for having me. Wonderful to be here.
I have been so excited about our interview, particularly because you're an expert in AI as well as ETFs, but I want to start with AI. AI and machine learning has been transforming industries everywhere. So tell me, how do you see AI transforming trading, and what can that mean to individual traders?
That's a really good question, and it really has been a topic in the forefront on all the discussions and on everybody's mind. I think, like, number one questions people are, is it going to steal my job? And I think so far what I have seen, it has not stolen any jobs, just like any other industrial and technological revolution. It has somehow created more work for everybody. And I think, like, really what it does, it doesn't replace the need for analysis, and it doesn't replace the need for critical thinking. It just makes it easier to digest large amounts of data and analyze large amounts of data. So, in terms of the kind of data people were able to use in the past, traders were able to get historical prices or maybe volume data, but nobody had the time to like read through every SEC filing of every company in the US. And I guess their, analysts would do that and write reports, and it would take them a couple of weeks to write reports. And basically what AI does, as soon as companies files, then 10Ks and 10Qs, and as soon as, large managers file their 13Fs, machines can immediately read all the filings and sort of distill the information into something that the traders can use. So I think that's kind of like what we're seeing happening in the industry.
Yeah, I love that. And some of the areas that I've been interested in as well is that there has been some inroads into biometric AI, where you can actually monitor your own body signals, where you're potentially getting overwrought with the markets, and the
Yeah.
AI can actually help you with that. So I think there's a lot to look forward to, as well as, people feeling a lot of fear about AI. But as traders, I think that being able to analyze large amounts of data, including our own body signals, is just so exciting. I think it's a winner. So, yeah, I like where you're coming from. What do you think are some of the most exciting AI driven tools that are available, and how can they help traders improve their performance?
I would say, like, there's been two things I have been excited lately. So one of them, you can sort of, and this is not like an advertising for a particular, AI provider. Sometimes when I will say like Chat GPT, I mean all of them in aggregate.
Yes.
Uh, but what has been exciting, you can sort of get feedback on what you've been doing. So, like, for example, recently I asked GPT what they think about HTAA and what they think about the fund. And it's interesting because they will go, like, the AI will go through your website and all the articles about you and kind of like tell you, okay, this is how you're presenting yourself. So it's like a form of like independent feedback, which you can use to be like, okay, so investors don't know enough about this, because if the AI can find it, somebody who's trying to maybe learn about our fund is never going to find it. So it's a good, feedback loop and just kind of analyzer of information. And the second use I've been really passionate about is the co-pilot ability. So basically, I wouldn't call myself a developer or a coder. I'm a scripter. I can analyze data, write some R scripts, a little bit of Python if I have to. But with what AI has been able to do, we have these Copilot extensions that basically give me coding suggestions. So I think that like opens the door to be more quantitative for a lot of traders and for a lot of quants who maybe feel like, okay, the coding languages are developing so quickly. I used to be good at MATLAB, but I'm not really comfortable with Python. And the AI makes it so seamless to go from a language to a language and to, even if you sort of know what you want the program to do, but you're not exactly sure how to write the algorithm, you can get a ton of help with the AI tools out there.
Yeah, I like that. I also like that behind what you're saying is that you do, as the user, need to have some knowledge before you just hand it all over to the AI. Like, if you want to use confirmation bias with AI, it will feed right into all of those things that may not be accurate. So, to have some knowledge first and
Yes.
then use I think is really critical. Like, I actually asked ChatGPT one time, I said, why should every single trader only have a top limit of $500 per trade, no matter what their equity size? And it produced an entire essay as to why that was true. And you and I, we know that position sizing is so important, and having that ability to have a method to run in order to get the right position size is critical. So to have a little bit of knowledge is good, and to help yourself learn using I think is fantastic, but you still do need some knowledge, don't you think?
Oh, absolutely. That's why I said it's not a replacement for any of us. It's a tool, and we just need to learn how to use it.
Yeah, absolutely. One of the things that I love this group in Israel is looking into, they're thinking about ways to give feedback to traders based
Mhm.
on their results. So they take their data, and you have to enter in a lot of detail to be able to do this, like the time of day you took the trade, whether you had a good night's sleep the night before, what your nutrition intake was during that day. And when they collect enough data, then they tell you, never ever trade on Wednesday afternoons.
Okay.
So, yeah, I think there's some future for individual traders to really maximize their own performance.
Yeah,
Yeah.
absolutely. This reminds me of some of the research we used to do in the past a little bit. We would look for what we call market anomalies, and we would look for, patterns in market returns that you couldn't explain by any kind of macro or fundamental data. And some of the topics that always have been very research and kind of controversial would be things like air pollution, cloud coverage, moon phases, solar and lunar eclipses. And I think it kind of goes back to like what you're saying, like, do these things affect the psyche of the traders? Do they affect how they sleep, how they feel? And it'll be very fascinating to see, now that we have a more granular way to look at it. Now you can look at somebody's resting heart rate, or you can, calculate their sleep score and try to like tie that to it, if we might finally be able to explain or debunk some of these more esoterical features that people have used to predict market returns.
Absolutely. And the thing that ties in so nicely with this is that there's a big study that was done in London on floor traders, and they've replicated this throughout the years as well. So it wasn't just from that old study. But what they looked at is that the traders who were the most physically aware of what was happening inside their body. So, what was their heart rate doing? Was their stomach grumbling? Were they feeling like they needed to break out into a sweat? Those traders with the highest level of interoception, which is a strange word, but it's the inside, looking at your inside and how you are aware of it. So those that had the highest level of interoception awareness were the best traders, which is
Okay.
interesting. So I wonder whether some of these methods are going to actually help us all develop a higher level of interoception. Yeah.
I think that's very possible. Absolutely.
Yeah, yeah. Hey, I want to also talk about ETFs. Now, exchange traded funds, a fun fact for 2024, 96% of ETFs actually were profitable. Now, isn't that fascinating? Because often traders, we get discouraged if our hit rate isn't going the way we were hoping, even though it makes no difference to our overall profitability. Because we know one of the most highly paid groups in the world, the Turtles Trading, their hit rate's only 35%. But because they pyramid so beautifully into positions that are winning, oh my gosh, they make millions of dollars, millions and millions. So it doesn't really matter about your hit rate, but it does make you feel better, doesn't it? So ETFs really have piqued my interest, and a lot of my traders are trading ETFs. I'd love to hear about your research because you have focused heavily on ETFs, and I know that they're a powerful tool, but how has your work in this space evolved?
Okay, so we actually launched an ETF. So we at Whole Tactical, we are, I guess you could say, ETF provider, even though we only have one fund. But we are huge fans of ETFs. And when we launched the fund almost 10 years ago, we actually faced the question, what investment vehicle should we choose? Should we launch this as a hedge fund? Should we launch it as a mutual fund? Should we launch it as ETF? And now, ETFs are definitely taking over the world as far as, I would say, popularity of investment vehicles. But 10 years ago, I think it was a little more
Yeah.
equal about, what people were launching. And even though like our strategy is very much what you would expect to see in a hedge fund, from the standpoint of like what the research looks like, what the trading looks like, we chose to launch it as an ETF. And sort of what we loved about the ETF as a trading vehicle, we love how accessible it is to everybody. So instead of having to, be only available to a select group of qualified investors with, minimums of hundreds of thousands of dollars to invest, you can be listed on the exchange and anybody can buy a share of our fund for, $37. So that way, anybody who thinks this, oh, this is kind of cool, this is cool research, can just go and buy a couple shares. There's no commitment and there's no like holding and like lockup periods. If somebody decides like, okay, I'm done with this, they can just sell it tomorrow. So we love, the ease of access. We love what ETFs do to the cost of investing. I think ETFs have really like flattened the management fees. It's really hard, and especially as you said, like given how well they have been performing, it's really hard to justify, paying huge performance fees and big management fees when you can get really good investment vehicles for very reasonable prices out there. And the third things we love about ETFs is the transparency. So ETFs, as I'm sure most of your listeners and viewers know, publish their baskets every day. So there is no, what are you doing with my money? There's no like, okay, I don't really know what I'm gonna get back if I try to sell it. Every day you get a full visibility into what the ETF's holding in the basket, and you get a full visibility into the track record. You can fully analyze the manager's performance. You're not just relying on some like monthly or quarterly report. So you can get a much quicker idea about like, okay, is this manager good? Is this manager bad? Do I like this fund? Should I stay in it?
Yeah. When I look at the performance of my traders in their superannuation portfolios, the ones that have got a fair chunk of ETFs are outperforming the others. I've got a $1 million club of traders where they've made $1 million out of the markets, right? So no mean feat. And all of them, every single one of them, have got a fair chunk of ETFs in their portfolio. So I think that speaks volumes. It also allows, from what I can see, a lot of people spread themselves too thin. Let's face it, if you're trading 100 shares, not only have you created a management headache for yourself, but you've also replicated some weird index of your own.
Yes.
So, why not just trade one instrument which represents a basket of positions? And that is
Mhm.
an ETF. So,
So,
a lot of my traders are trading index ETFs,
mhm.
and that gives them access to everything in that index, but through the one particular tool. So if you're new to ETFs and what we are saying here, it sounds exciting, then you need to put in some research. Really
Mhm.
have a look to see whether ETFs can form a part of your long term plan. These are not a short term instrument. I'd love your thoughts on that, actually, Petra, to see what the research says with this. But from what I can see and from my own experience, this is a medium term instrument. Have you
Mhm.
found the same for your traders as well, Petra?
I think generally speaking, that tends to be true, unless you have a good reason and unless you have a verifiable edge in making trades, you're better off, being very conservative about when and how often you trade.
Yes, absolutely. And you're a quant. I know a lot of people are not familiar with quants. I was explaining what a quant is to my daughter this morning, but I'd love to hear your explanation and how this has helped you become effective in terms of the industry of trading.
Okay. I would say what quant aims to do is I would say it would help us make better decisions. I think that would be in aggregate. I think quant is a very broad category, but we know as humans, we have emotions and we have different biases. And you've mentioned a few of them earlier when you talked about, how traders feel and how they trade. And I think what people look to quant to do is to help us be more disciplined. So I know, I just came back from a conference in Vegas and I talked to some advisors there. And a lot of what I have been hearing, like people don't expect you as a trader or as a money manager to have a crystal ball. But what they want you to do is to give them a fighting chance to, even if the markets are very uncertain, even if you think there's a lot of volatility, they looking for you to, give them a chance to like respond when the new information comes in. And like if we head into some kind of turbulent period, they're looking for a chance to like, okay, somebody is paying attention and somebody will have the option to act on my behalf. And I think quant can be really helpful with that because what quant allows us to do is to analyze the data and analyze similar points in history, and basically respond accordingly. So again, no crystal ball. None of the quant strategies know exactly what's going to happen tomorrow. But what the quant strategies can do, be like, okay, so when inflation was this, when unemployment was this, when a market has dropped 20% historically, what happened was this. And it allows us to remove some of the biases that we might have, you know, as you mentioned confirmation bias. So like, if I am really worried about inflation as a human trader, I may like remember, oh, that one time when the inflation report came out and it spiked and the market dropped. I really need to like sell everything I have before the next inflation announcement because I think it's going to go down. But what the quant strategy can do is like, no, actually, if you look at all the different inflation announcements for the last 20 years, it's not always the case that the market drop. You should not sell all your holdings before this announcement. And it allows you to, focus more equally on the history. It allows you to remove some of the fear from your decision making and then hopefully make, better decisions over the long run.
Yeah, yeah. The synthesis of data is such an important area. When I was describing this to my daughter, she came up with the term with me, which I thought just described you beautifully, is you are the human AI. So looking at all the data, finding patterns and finding areas that need to be explored further and researching those areas for the good of traders everywhere. Tell us a bit more about your research. Is there anything that you can provide for my traders that would work for them based on your research?
So we can provide a lot of things. So one thing that hopefully is a little bit unique about Whole Tactical is we are very passionate about our research, and we are not secretive at all. We have published, I think, 4 or 5 academic papers to this date about basically all the different models that we're trading. So if somebody just wants to learn about, okay, this is how these guys do research, we show links to all our papers on our website. And also what we do if somebody doesn't feel like replicating our research, because it's actually a lot of work to replicate our research, what we also do, we publish our signals for free on the website. So if anybody's interested in, okay, like what do these guys think the market's going to do tomorrow, they can just go to our website and there's a daily report that shows us, you should be 110% long tomorrow, or you should be 70% long tomorrow. And we even explain like how we arrived at these allocations. Is this because we think the fundamentals are weak? Is this driven by sentiment? And so people can subscribe to this daily report, and like every day they can know what we're doing if that's something that's interesting to them.
Absolutely. And just to make sure everybody knows where to subscribe, it's Hull, Hull, tactical.com. Hulltactical.com. That's right, isn't it, Petra?
That's right. That's our advisory website where people can find our daily report. And also
Fantastic.
they can find our blogs. So if they're interested in sort of like how we think about research in a really friendly way, I would also check that out. I think it's a good reading.
And I'd love to know your thoughts about the key metrics that traders should use, because you've come across so much research and you've done your own research. What are the key things that traders should monitor so that they can improve their own performance?
I think the key metrics may depend a little bit on what your goal is and sort of like what your investment mandate is. So for us, it might be a little bit different because we are a ETF manager. So we have clients, joining our product on a basically daily basis. So we don't just care about over the last 10 years, what was the return? We really care about like how we realize that return, to make sure it's not all concentrated in one good period, and then everybody else who missed that one good period is just too bad. So we care about rolling metrics. We care about, for example, rolling 2 years returns and like returns relative to the benchmark. So for us, we compare ourselves to the S&P 500. And so what we really care about is like, on 2-year periods or 5-year periods, how often do we overperform or underperform the S&P 500? And that can be expressed by either excess return, or that can be expressed by market alpha. So we are very interested in our rolling market alpha as well.
So to distill that for the individual traders who are listening, there's two significant aspects that are directly applicable. Firstly, look at how you are performing in relation to the benchmark. Compare yourself to the benchmark index of your country. In my country, it's the All Ords. So that's the top 500 by market capitalisation shares in Australia. Or you could even use the ASX 200, which is just fine as well. But the other aspects that you've mentioned, which is something that I definitely believe in, and Tom Barso, one of the market wizards, has definitely imprinted in my brain. Don't just take one or two trades. Look at that rolling figure. Look at multiple data points as to your performance, rather than judging yourself on the outliers. Like this one you did brilliantly, this one you really flopped. And don't take those extremes as being gospel. You need to look at data over a longer period of time, and each trade is just one separate data point. That's all it is. And I think that can remove a lot of the angst. What are your thoughts about that? Is that a good translation for individual traders?
Absolutely, yes. I think people, again, it goes back to the biases. Like people will look at their one successful trade, and we as humans, I am guilty of this as much as the next person. When we do well, we think it's our skill. When we do poorly, think it's bad luck. So I think, it's important to be really realistic. Like, how much skill do I actually have? How much luck do I actually have? Or how much bad luck do I actually have? And I think it's going to save you a lot of money if you can realistically understand the size of your advantage. I would say, one of the things people may not know about our company, we were founded by a really famous options trader who started as a blackjack player. And in
Oh,
black, if you're counting cards, it's really important to know like what size of advantage do you currently have and bet according to the size of your advantage. So if traders can be really realistic about understanding like, okay, not just like extrapolating off of the best trade they've ever made or the worst trade they've ever made, if they can realistically understand the size of their advantage, that makes them make better bets in the future.
the other area that I find fascinating, which is like a Venn diagram where we share an interest, is backtesting. So, with backtesting, I watched a lecture of yours and I actually stopped it. I paused it and wrote this down. You said, I've never seen a bad backtest. Tell me exactly what you mean by that and how can traders use this information?
Absolutely. So first of all, I cannot take credit for this quote. I was paraphrasing. The place I saw it, or the person I've heard it from, was, I think it was the head of research at MSCI, Dimitrios Melas. And I'm not even sure if he was the original author. This is a pretty famous quote. It gets, echoed through the industry. And basically, what it means is, I guess you're doing your own research. Sometimes you see back tests. But even for me, I'm sort of like starting from a back test that sort of works, and then you never quite. I feel like, okay, so I will give you like two examples. One is like your own back tests, and one is if you're working with, evaluating somebody else's back test, some other trader, some other hedge fund managers. So with your own back testing, you're already starting from some kind of a baseline model. And it's easy to just assume that, okay, this is a random chance, but you underestimate, how you got to the baseline. The baseline didn't just like randomly, you didn't randomly generate uh 12 predictors. You didn't randomly generate all your hyperparameters for your strategy. And people tend to think like, oh, I just tweak one thing and the model got better. But how many of these like one thing tweaks you made? And are you like realistically keeping account on, oh, this one didn't work. You easily forget like that one backtest that didn't make it better, you discard it. You only remember the one that did make it better. And then you think like, oh, I have improved my strategy by 20%. But you sort of conveniently forgot about, the other 10 backtests that you ran that actually made your strategy a little bit worse. And I think it gets even worse when you're evaluating somebody else's strategy, because like, even if I'm working with somebody who means super well, they're not bringing me their failures to tell me like, look, Petra, I just lost, in the back I lost the company $500,000. They're only bringing me the ideas and the suggestions like, oh, look, this could possibly make us $500,000. And so you have to sort of not to, generate some kind of like mistrust, or not to generate some kind of, culture of not believing anything and anybody, but just kind of be mindful that, all the unsuccessful trials land in the trash can. And what we end up seeing is just the stuff that worked in the backtest.
Exactly. And I see on social media a bit where they show back tested results. And I just know there's a tell that they're fake. They're fake back tested results. And I'll tell you after I get your answer. How do you discern between a real back test? What do you see in those results compared to one that you know is rigged and fake?
Okay. So I would say there's a couple telltale signs that I'm looking for. So first of all, depending on what they're trying to do, I have developed a certain too good to be true mindset. If something seems too good to be true, it probably is. I would say the only fund or the only strategy that never had a losing month was Bernie Madoff's strategy. and we know that it was a Ponzi scheme. So even with the advancements of AI and machine learning, if somebody tells you their machine learning model to predict next day's return of the S&P 500 is a sharp 5 and growing every month, maybe you should be a little skeptical. So I feel like too good to be true is a good telltale sign. And then another good telltale sign is if they're being like, if the choices of the periods they're showing you are very random. If somebody is like very specifically showing you 15 and a half month back test, that can be kind of suspicious if it's not some kind of standard 1 year, 3 year, 5 year, 10 year periods. And if there's not a good explanation about like why they are only able to show you these specific 107 data points as opposed to something more robust. So that's another good
Yeah.
sign.
The big one I've seen, which just honestly, as soon as you see it, you just know, wow, that's actually not accurate at all, is where they make their profits from the very first trade, because
Mhm.
pretty much you're going to be stopped out of a lot of trades very early on when you start putting money into the market. So your
Mhm.
equity curve will take a dip. It will, because the ones that are going to be profitable take a lot longer in terms of actual time frames to reveal that profit. So, for example, you could make a complete mozza of it on 3 trades. They go initially towards your initial stop, you're out, and then the ones that made profit, you could be in them for 2 years. So, you're gonna take a dip in your equity curve before it goes up. So, the important thing, I think, with this, for every trader who is listening, is do not believe everything you see on social media. Realize if it is too good to be true, it is too good to be true, and trust yourself. Work through an educational process so that you are able to discern, because that way you're not going to get suckered in by the next big talking clever person who's going to use words and make you feel inferior. You give your money over and then you find out that actually nothing of that is ever going to work. I do think traders struggle with drawdown. What would be some of the techniques that you can help us with for traders experiencing that maximum drawdown?
I would say there's a couple that I think are important that we use, and one of them well, I would like, before we go to like the actual like trading techniques, I would, for a second, I would go back to the back testing. So I think the drawdowns are hard if you don't know if they're temporary. So if you have a good back test and a realistic back test that's not, overfit and too optimistic, you should have seen some drawdowns in your back test. And I think a lot of them are temporary. A lot of the strategies do come back. And if you understand, again, this your strategy well, first of all, do not panic. Like, drawdowns are a part of life. And if you know, like, okay, in the back test, I've seen a 20% drawdown and it was okay. And it happened during these kind of market conditions. And this is kind of the market conditions we're in right now. You can just outlive a drawdown. As painful as it might be, sometimes all you need to do is like, sometimes stick with it. And a lot of times, especially when the markets are dropping, those are the buying opportunities. And having that confidence that, like, yes, this is what happened in the back test, we started, buying more. A lot of times you can sort of, trade yourself out of a drawdown. And then as far as, obviously that's easier said than done. And then as far as like kind of like the mechanical tools, I would say bet sizing is really important. It's important to stay in the game. And that's kind of our, one of our mantras. We have a couple kind of like company-wide mantras. One being like bet proportional to the size of your advantage. I already talked about that a little bit. Second is make a lot of bets. So that was like another lesson a little bit from our blackjack history, was, diversify your bets and make more bets. So a lot of times that can help if they're not just like piled into like one giant positions. They're just holding and waiting for a miracle to happen. Like, have some kind of a strategy where, if you can make, twice as many bets, 3 times as many bets, you can like work yourself out or draw down faster. So that's helpful. So, but proportionally to advantage, but often, and stay in the game. So
Mm.
have a plan, have a risk management plan, and have it in place before you start trading. So part of what we do on the prop trading side of the business, we do have a options trading operation, and especially with options, the way the nonlinear risks of options, uh, we do have a plan way in advance. When we hit these kind of risk limits, we're cutting deltas by half. When we hit these kind of risk limits, we're cutting deltas by this amount. And to have that plan and execute on it, just stay in the game. So drawdowns happen. And what's really important is, can you still come back and trade again tomorrow? So
Mm.
we don't believe in some kind of Hail Marys and some kind of, miracle trades. Have a plan and stick with it.
Listen to the similarities between what Petra is saying and exactly what I'm teaching you as well, especially for members of my mentor program. Now, the study that we have done with our own traders and with our own back testing, you've heard of the 2% risk model, because that's a very common. You risk 2% of your overall equity in a particular position, and then you're less likely to go broke. But we've actually found that 1% risk outperforms 2%, and 0.5% risk outperforms 1%. And it is exactly what you have said there, Petra, where you've got a large variety of smaller bets, smaller positions in the market. And then once you've got ones that are going, and like a rocket, you feed it rocket fuel, which is money, and you pyramid into it. So listen for the similarities between what Petra is saying and what I'm saying. There are some universal truths about trading, and so many of them have been revealed today. Petra, you are just a sparkling individual. I know a lot of people are going to be curious about, what is a day in your life like? You're the CEO of a huge company, Hull Tactical, and definitely download Petra's free daily ideas about the markets, because that through hulltactical.com is going to get you a long way. Tell me, Petra, what does your usual day look like? And then we'll close off because we are out of time.
Absolutely. So my days, as I spend more time and as the company grows, have been sort of evolving. So I don't assume anybody has read my bio yet, but I'm sure they will after this episode, except for you, Louise. But I started as a quant. So my origins are, doing research for trading firms. So I used to write a lot of scripts, analyze a lot of data, and then sort of like as we grew as the company and as we launched this ETF, my role has evolved a little bit. So I am still involved in the research because that will always be my passion. And that will always be something that, I sort of like tend to gravitate to. But now I work with a lot of individuals who are a lot smarter than I am. So I have sort of given them the opportunity to do most of the research for the company, and I spent a good number of hours every day, more talking to advisors, more talking to clients, sort of educating them about our research and explaining what we do, how we think about investing, how we explore new ideas. And it's kind of like a two-way street. I try to answer questions about what we do, and I also try to learn about, what people are doing that we may not be doing yet, in terms of, are there data sources that we have not considered that we should be looking at? Are there new modeling techniques that we have not explored yet? So sort of, looking for new ideas on how to enhance the experience for our clients.
Oh, I love it. Petra, you are a breath of fresh air. Thank you so much for coming on the show. Any parting words for the traders?
I would say I know we're entering probably periods of high uncertainty, but this is exactly the time to not run away from the markets. But this is also the time to be disciplined and smart. So, build your model. If you want to compare notes, reach out to us. We're always happy to talk about research and modeling. And then we're just going to stick with the model, and I'm sure we're going to come out happy on the other end of the trade.
So until next week, for all of my Talking Trading listeners, happy trading, keep your cool. Remember, every single trade is one data point amongst thousands. And I'll see you next week.
Thanks, Louise.